Today on the program, Moody's says South Africa unlikely to stabilize debt by 2023. Djibouti sets up sovereign wealth fund, targets $1.5 billion in 10 years. And Ghana Bank governor fears ballooning deficit not sustainable. Thank you for joining us on Business Incorporated. I'm Chimezie Obi Iwagu. First, the market. The Nigerian stock market and the JSE index in South Africa moved sideways at intraday. The NSE stock index was down 0.28%, while the JSE index was up 0.57%. The market in Egypt is closed, but was down on Thursday. Kenya also closed in the red on Thursday. And markets in the Middle East closed. However, most of them traded lower on Thursday, except Saudi Arabia. Saudi Arabia's benchmark index closed up 0.26%. Qatar's index eased 0.44%, with Qatar National Bank losing 0.9% and Commercial Bank shedding 1.1%. In Dubai, the index declined 0.61%, with its largest bank, Emirates MBD, declining 1.7%, and Emma Properties down 0.7%. The Abu Dhabi index retreated 1.02%, pressured by a 1.6% fall in the country's largest lender, First Abu Dhabi. And European markets advanced on Friday morning despite surging coronavirus cases in the U.S. and further warnings about a second market meltdown from the International Monetary Fund. There are other news driving market today, and Chelsea will tell us. Good afternoon, Chelsea. Thank you for joining us. Well, Europe's biggest accounting scandal in recent memory continues to unfold, and now regulators are coming under fire for turning a blind eye to the potentially wide-scale fraud of fintech firm Wirecard. How did German regulators miss this?
That's really the big question. Wirecard is a big name in payments processing here. So it sort of connects people who are trying to pay with an online card or pay online for things, and they sort of are the middlemen in that transaction between the buyer and the seller. But they have been really getting hit with allegations of all sorts of fraud for over a year, almost 2 years now. There have been numerous reports from journalists. There have been investigations in other countries, and investors have repeatedly sounded the alarm on this company. And the German banking regulator really did nothing. They actually defended Wirecard for years. They introduced a ban on betting against the company for a short period of time. They even went so far as to investigate and launch a criminal complaint against some journalists and some investors who had been raising the alarm about fraud at the company. So there's obviously a big question about how the banking regulator missed this, why they were defending Wirecard against these allegations that are looking increasingly true. So there are now a lot of calls for investigations into the regulator itself, why they missed this. Because this is a bigger reputational risk for Germany. Investors need to know that their money is safe in Germany, that regulators are doing their job and making sure that companies are real and that the things that they're reporting are true. So there's a big blowback on the regulators here, and there could be potential consequences for the regulator and changes to how it operates going forward.
But the sudden implosion of Wirecard is being celebrated by some investors and hedge funds who have been betting against the firm for years. Tell us about these so-called short sellers and how those bets have worked out.
I think for these investors, this has been really a week of vindication. As I said, Wirecard has been the target of a lot of investors for years now who thought that the company was engaged in some sort of fraud. So it's been really popular among these investors called short sellers. What they basically do is borrow the stock at a level they think is quite high, and then they sell it to somebody else, hoping at some point that they'll buy it back for much cheaper. So it's kind of complicated, but essentially they capture the difference between those prices, and they make money if a stock declines. So it's been one of the most popular bets for short sellers here in Europe, and for a year and a half, 2 years, they've done nothing but lose money, in part because of the defense of people like the German regulators who said things were going fine at Wirecard. But now that the company is imploding, now that they have declared for bankruptcy, these short sellers are really making a lot of money. In the past week alone, the 8 biggest short sellers have made about $1 billion on those trades, and even more if you look at all of the short interest in this company. So a big day for those investors who have been holding on to these positions for a long time.
And a day after Lufthansa's €9 billion bailout was approved by shareholders, rival Air France KLM said it will get another €3.4 billion lifeline from the Dutch government. That's after receiving a €7 billion bailout already from France. Why are Europe's airlines so dependent on government support?
This has been one of the big questions this week, as we've seen a lot of these bailout packages either be approved, as in the case of Lufthansa, or seen more of them, as in the case of Air France KLM. Why are some airlines needing so much money right now when others, like the British Airways parent AIG, hasn't asked for a bailout? This has been particularly criticized by Ryanair, the budget carrier, which says that these bailouts are really unfair, that it's not fair that some countries and some companies have the support of a country like Germany and others are getting nothing from their government. So there obviously is the fears that this is going to make the playing field less even here in the European airspace market. But there obviously was a bit of a difference between a lot of these companies coming in. Companies like Ryanair or IAG had a lot of money, they had a lot of liquidity, they had a lot of cash and other sources of liquidity coming into this crisis, and others like Lufthansa and Air France KLM just didn't have as much money set aside. So they had as much money as they thought they could possibly need, but nobody could have really foreseen the coronavirus crisis. So this definitely does also point to a lack of liquidity on some of these companies. But now, obviously, they are having to face these bailouts, and that's not being shared equally across the market.
Well, Chelsea, I guess it's time to say thank God this Friday. It's been a beautiful week with you. Enjoy the rest of the weekend. And stocks in Asia Pacific mostly rose on Friday as the coronavirus situation stateside continued to be monitored by investors. In Japan, the Nikkei 225 rose 1.13% to close at 22,512.08, while the Topix index added 0.99% to finish its trading day at 1,577.37 points. South Korea's Kospi also gained 1.05% to close at 2,134.55. Hong Kong's Hang Seng Index bucked the overall trend regionally as it slipped 0.77% as of its final hour of trading, with shares of Chinese tech giant Alibaba dropping nearly 3%. Meanwhile, shares in Australia advanced, with the S&P ASX 200 up 1.49% to trade at 5,904.10. Overall, the MSCI Asia ex-Japan Index rose 0.36%. Markets in China were closed on Friday for a holiday. And U.S. stock futures were lower in early morning on Friday following the release of the Fed's latest bank stress test results and disappointing quarterly numbers out of Nike. Dow Jones Industrial Average Futures were down 174 points, while S&P 500 and Nasdaq 100 futures also traded in negative territory. The moves came after the Fed's annual stress tests of the major banks showed some banks could get close to minimum capital levels in scenarios related to the coronavirus pandemic. Because of this, banks must suspend share repurchases program and keep dividend payments at current levels for the third quarter. The announcement sent some bank shares lower in after-hours trading. Bank of America and J.P. Morgan Chase both dipped more than 1.8%. Wells Fargo's slid 3% and Goldman Sachs fell 3.4%. Bank stocks were coming off sharp gains, rallying more than 3% during regular trading on Thursday. Meanwhile, Nike shares slid nearly 4% after the bell on the back of a surprising quarterly loss for the apparel giant. On global oil market, prices rose on Friday morning, extending gains from the previous day on optimism about recovering fuel demand worldwide despite a surge in coronavirus infections in some U.S. states and indications of a revival in U.S. crude production. U.S. West Texas Intermediate crude futures gained 42 cents to $39.14, but were on track for a slight drop for the week. Brent crude futures similarly rose 1.1% to $41.52, but were also heading towards a small decline for the week. Overall, commodities markets were taking a positive view on the global recovery on Friday, despite worries about coronavirus flare-ups. And on metal, gold prices were headed for their third consecutive weekly gain on worries about rising global cases of the novel coronavirus. Although prices seesawed on Friday after a firm dollar and a gain in equities countered safe haven demand. Spot gold was steady at $1,760 per ounce. The bullion has risen more than 1% so far this week, with prices scaling a near 8-year high of $1,779 on Wednesday. U.S. gold futures rose 0.2% to $1,770 per ounce. Holdings of the SPDR Gold Trust ETF stood at more than 7 years high. In other metals, palladium gained 0.3% to $1,847 per ounce, but was heading for its worst week since May 1. Platinum was flat at $803. Silver fell 0.9% to $17.71. And away from the markets and back here on the African continent, Djibouti is setting up a sovereign wealth fund for domestic and regional investment and aims to fund it to the tune of $1.5 billion over the next decade. Wealthy nations traditionally use sovereign wealth funds to invest surplus billions overseas to prevent inflation at home, diversify income streams, and accumulate savings. Djibouti will, however, use its fund to finance domestic investment, including in telecoms, logistics, and infrastructure sectors. It will also prioritize investments in the Horn of Africa region. The tiny nation is home to both Chinese and U.S. naval bases. Its strategic position on the Gulf of Aden means it overlooks the world's busiest shipping lanes for oil cargoes. The fund, whose sole shareholder is the government, will be required to reinvest all its net profits. And Ghana's Central Bank Governor Ernest Kwamina Addison says Ghana needed to raise more domestic revenue to tackle a ballooning budget deficit that could exceed 7% of GDP this year as growth shrivels due to the coronavirus crisis. The deficit hit 3.4% of GDP in the first quarter against target of 1.04%. It says reforms over the past 3 years had helped to stabilize the economy, boost growth, and curb inflation. But this was being threatened by the pandemic, which has hit Ghana's oil sector, tourism, and education, among others. The government and the bank have taken steps, including the purchase of government securities to cushion the impact of the pandemic. The bank's Monetary Policy Committee will meet in July to assess the impact of current measures, and the bank may take further action if necessary. And Botswana has issued its first licenses, allowing 3 private companies to generate their own power, which will mostly be destined for export. The independent power producers have received 15-year generation licenses and will produce a combined 827 megawatts of power. State-owned Botswana Power Corporation is currently the sole producer of electricity, but the country is looking to diversify with several private investors at various stages of setting up coal, gas, and solar power projects. Despite its huge estimated coal resources of 212 billion tons, the diamond-rich country only has 2 operating coal mines, with several investors at various stages of setting up coal mines for either export or power generation. Lack of adequate rail infrastructure and the high cost of road transportation have been holding back investments in Botswana coal sector. And Kenyan Central Bank on Thursday held its fire on interest rates for the second time in 2 months, saying the easing measures it had adopted since the onset of the coronavirus crisis in March were working. Policymakers who lowered the key rate by a hefty total of 125 basis points in March and April after Kenya's first case of the COVID-19 disease was confirmed, left it unchanged at 7%. Aside from monetary measures, there are other fiscal measures taken by the government. During his budget presentation on June 11, Finance Minister Oka Yatani unveiled a stimulus package worth just over 50 billion shillings targeted at key sectors like tourism. And just a few days ago, the National Assembly approved a raft of tax measures, including a change on all companies as the government seeks to boost revenue and navigate the coronavirus fallout. Well, joining me now to unpack all of these measures is the policy and governance expert at Sovereign Insight there in Kenya, Vincent Kimosop. Hello, Vincent. Thank you for joining us on the show.
You're welcome. How are you?
Very well, thank you. Well, let's begin with the tax issues. A raft of tax measures were approved by the National Assembly in the Finance Bill 2020, and that includes a maximum tax of 1% on gross turnover, zero rating value-added tax on wheat and maize flour, removal of excise duty on betting, rental income tax of 10% on gross income, capped annual rental income to be taxed at 15 million shillings from 10 million shillings. What is the implication of these, not just for government, but individuals and businesses?
First of all, of course, it's evident to all that COVID has adversely affected business. Currently, when you look at the number of jobs that the economy has shared, so increasing taxes would not yield any results, particularly on the part of government, and the only option would be to lower the existing taxes. First, to accept the reality that businesses are having a difficult time. And then secondly, also is for those that are working to facilitate them by capitating them so that the money that they would have actually paid in form of taxes, they could be reinvested so that they can be kept afloat and thus keeping jobs. On top of this, there is also plans towards supporting them in ensuring that they can access credit so that post-COVID, companies are kept afloat by ensuring that they're liquid.
Now, both the monetary and the fiscal authorities have come up with different measures to curb the impact of COVID-19 on the citizens, including unveiling a stimulus package worth over 50 billion shillings. And of course, we had the Monetary Policy Committee yesterday leaving the interest rate unchanged. Are you happy with the measures so far?
Yes, I can be able to say that if the fiscal space is shrinking, and therefore you can see the constraint and that on the fiscal side, which then explains why taxes are being lowered. But on the monetary policy side, you can actually be able to see the impact of the measures they took. For example, when they removed or waived the costs of money transfers, and for monies that are above 1,000 shillings, you realize that there is increased activity there, and that has helped ensure that there is a higher money circulation. The poor are also able to benefit out of this, because when you look at the percentage of even the amounts of money that are actually transferred on mobile phones for the caps that have been given, you can see that they are low value and they're over 80% of the transactions. The other thing is also it has increased the use of digital platforms instead of the use of physical legal tender. And as you know, part of the guidelines on avoiding COVID was reducing the use of physical materials like cash. So yes, there is impact of some of these policies. There is no evidence as to whether the measures in terms of scientific data or research done. But when you look at the spread, you are able to say that by proxy indexes, that indeed some of these measures are making a difference, even though the resultant impact is devastating on the economic front, both the macro and at the micro level.
So what is the situation with the lockdown measures? How is that playing up, and how much has it helped in curbing the rising of COVID-19 cases?
And that's why I was explaining that because there is no evidence in terms of data or research that is independently done on the impact of the measures. So I can only speculate that when you look at the projections that were given, that if there are no measures that are taken, then we were looking at by now up to over 30,000 disease spread or number of reported cases. But as at now, we are at 5,000. Slightly 100 people who have died, and over 2,000 recoveries. So meaning that these measures, you cannot say conclusively, yes, they have led to a reduction, but if the projections that were given at the beginning are to be believed, then you can confidently say that they are making a difference.
And what is your outlook for Kenya's economy, and what would drive growth post-COVID-19?
Of course, so number one is that we will definitely see an economic growth reduction. We were projecting over 6% economic growth rate before COVID, but now that has been revised to 2.5%. That means that we have to look at productive sectors, looking at getting back our service industry back, getting back, supporting the agri businesses, and also small and medium-sized enterprises. That is where the growth is, because the turnaround for manufacturing and other sectors will take long, and their impact on the economy has to have a long-term view. So we have to work with those sectors that their turnaround is higher, and also keep helping in keeping the jobs that are currently existing.
All right, thank you very much, Vincent, for your time. Vincent Kimosop is a policy and governance expert at Sovereign Insight in Nairobi. And ratings agency Moody's says the South African government target to stabilize its ballooning debt by 2023 will be very difficult to achieve and unlikely. The Treasury on Wednesday presented a supplementary budget in response to the coronavirus crisis that projected a wider budget deficit, while public debt was estimated to be more than 3/4 of gross domestic product in the medium term. In its active scenario, the government hopes to achieve a primary surplus by fiscal 2023 that would stabilize debt. According to the rating agency, given South Africa's weak track record of fiscal consolidation in recent years and the weak medium-term economic outlook, debt stabilization by 2023 will be very difficult to achieve. The economy was in recession before the COVID-19 outbreak ravaged it, and the lockdown that followed late in March has put further strain on businesses and consumers. The Treasury projects the economy will contract 7.2% this year. And a vote on a restructuring plan for loss-making South African Airways has been delayed until next month after some creditors and trade unions secured an adjournment after months of wrangling over the airline's future. The administrators who took over SSA in December after almost a decade of financial losses published their restructuring plan last week and now expect the vote to take place on July 14. The plan involves scaling back SAA's fleet while keeping most routes intact, but needs the government to find at least 10 billion rand of new funds to pay some creditors, fund thousands of layoffs, and restart the airline as COVID-19 travel restrictions ease. It is not clear where those funds will come from after the finance minister allocated no new money for SAA in an emergency budget. The State Enterprises Ministry has said there are investors interested in partnering with a restructured SAA, but has given few details. And that's a wrap on the program for today and, of course, for the week. Thank you for watching. I'm Chimizi Obi Iwawu.